Comrade Sudarshan, Comrade Dilip Saha, Comrade Nagarajan, Comrade Franco, other senior leaders on the dais and below, and friends, ladies and gentlemen. I speak not for myself when I say this, but also my colleague. It has been for us a privilege to be associated in different ways with IBOACC now for many years. And it was a privilege to have been given this opportunity at this crucial time in the history of Indian banking, public sector banking in particular, as was pointed out, to be able to join you in this learning process in trying to understand the ways and means through which a neoconservative, neoliberal state is trying to engineer a redistribution of income by using many mechanisms, and one of those mechanisms, of course, is to use the banking sector as an instrument in a pawn to reach to a few what it takes away in different ways from the many. I say that this is a very crucial time in Indian banking, partly because if you look at it, when you find the time, if you look at the material we put together, you'd actually see that one of the recommendations or one of the ways which we think we should move forward in the immediate short run is for the government to use funds either from the Reserve Bank of India or from the budget or a combination of the two to actually address the immediate problem facing the public sector banking system, which is the huge accumulation of non-performing assets in its books. Now, simultaneously, we know that the government itself has announced a 2.11 lakh crore recapitalization plan. It's a recapitalization plan in which a significant sum is going to come out of the budget, partly in the form of recapitalization bonds and partly in the form of budgetary funds. Already the supplementary demand for grants has allowed for 80,000 crores to be used for this purpose. And other than for allowing for a certain amount of mobilization of monies from the market, this seems to be a declaration of this government, which has brought the banking system to its current state, to actually take on the onus of addressing the problem of potential insolvency, which is prevented only because of the fact that these banks are publicly owned and therefore have the sovereign backing of the Indian state. As a result of which, the trust which Comrade Sudarshan spoke of still remains because of the fact that there is a belief it's also a trust in the Indian state, on the ability of the Indian state to restructure these banks. So if you look at it, it appears as if we somehow seem to be on similar ground, that we are arguing that besides what needs to be done in the medium term and the long term, in the immediate short run, it is the duty of the Indian state to recapitalize these banks and put them on a solvent footing such that the business of banking, the use of the banking system as an instrumentality for development can be once again begun or restored. However, as should be clear to all of you, this similarity actually conceals something which is deeper and dangerous from the point of view of the agenda of the state, as opposed to the kind of agenda we are suggesting and the IBOACC has been suggesting should be advanced over a period of time. As far as the Indian state is concerned, it has been through the Reserve Bank of India, through the imputation of experts as deputy governors, through the finance ministry, and through the large number of committees which were referred to, which have been set up ever since the Narasimhan Committee was set up first in 1991, immediately after the July crisis, the balance of payments crisis, and the beginnings of reform and liberalization. That the whole idea was to try and in some sense get the banking system to a situation in which you would be able to move the public banking system out of the hands of the state and into the private sector. This was a battle for control which in the first instance during the colonial period was a battle for control between the British administration, which controlled the presidency banks, and the Indian banks, which particularly got to grow in the late 19th century, but more so after the Quit India movement, the Swadeshi movement, the Quit India movement resulted in sort of flourishing of indigenous banking, and there was an effort of Indian business to take control of the nation's savings, which thus far was being deposited in large measure in what was a British-controlled banking system, which served the interests of the British administration and British business. Now, after independence, what we actually had was that this private sector managed to consolidate this control to an extent where not merely were many banks part of business groups, but most banks had on its boards directors who, in one way or another, were responsible for moving the finances or the nation's savings, which were being intermediated by the banking system, into the large big business private sector. And this resulted in a situation, obviously, where there was a deep degree of exclusion. Sectoral exclusion, which was obvious with agriculture, which was then a very large part of the economy, even in national income terms, let alone in terms of employment as it is today, but received just 2% or less of the total advances which are being provided by the commercial banking system, into which, as equity, Indian business had put very little money. It was essentially a way of moving the nation's savings, for which the first port of call was the Indian banking system, into the hands of big business. So the fact that Indian business wrested control with the assistance of the national movement of the banking system from the colonial administration and British business, that this was used to consolidate control of big Indian capital over the nation's savings, and this resulted in a situation where even though the fragility of the banking system could to a certain extent be rectified through an appropriate banking act, which was constantly amended, by giving teeth to the Reserve Bank of India and its supervisory and monitoring capabilities. By doing all this, and by initially voluntary but subsequently compulsory mergers, particularly after the closure of Palai Central and Lakshmi Bank, that you did manage to reduce the fragility of the Indian banking system, shrink the number of banks from more than 550 to less than 100 in order to be able to ensure that these banks survive. But the control of this banking system rested with big business in India, which therefore had access to the nation's savings. Now, this obviously meant that the other effort which the government was putting in at that point of time, which is an effort to try and use the banking system as an intermediary, which, collecting the nation's savings, would be able to pursue other goals. One, the goal, of course, of promoting growth and development, and the other, the goal of ensuring the reach of banking services and financial inclusion in the sense of provision of credit to hitherto underbanked sectors, hitherto underbanked sections in the vertical distribution of income, to the hitherto underbanked areas, and in particular, of course, to the rural areas in general. That this effort, other than for the fact that it could be to a certain extent advanced by virtue of having nationalized the Imperial Bank to generate the State Bank of India in 1955, the government found that it was not in a position, despite the laws that it put in place and constantly amended, it could not persuade, it could not push, it could not sort of nudge the private banking system into actually serving the goals of larger national development, even though what was being intermediated by these banks was the nation's savings and not the savings of the private sector, which remained relatively low. So therefore, the government decided at a certain point of time, influenced of course by various political factors, but encouraged by the recommendations of a large number of committees which went into the issue, the Dutt Committee, the Malanovis Committee, etc., which went into the issue in the late 1950s and through the 1960s, decided in 1969 to actually wrest control of the nation's savings by going in for bank nationalization to achieve the goals of using the banking system as a means to promote growth, using the banking system to ensure a degree of financial inclusion, and making sure that the stability, the hard-won stability which had been achieved through the measures which were put in place between 1951 and the mid-1960s did not get undermined because of the indiscriminate use of the savings of the system to finance a few projects which are being established by big businesses in India. Now, if we look at it, from that date, 1969, till about the late 1980s, if we examine the success of the government in realizing its own objectives through the measure of nationalization of the banking system, the evidence is clear. This was a dramatic, almost historic achievement for a developing country functioning within the framework of parliamentary democracy and operating largely on the basis of a market mechanism rather than state control, to wrest control of an instrument of this kind such that the control of national savings and its allocation across sectors, sections, etc. would be determined keeping in mind the development objectives of the overall state. The evidence in terms of credit deposit ratios, the evidence in terms of regional spread of banking, the evidence in terms of access to brick and mortar banking to larger and larger sections, the evidence of movements of banks to underbanked areas. You take any of this and the results were dramatic. The achievements was great. So therefore, if you see what we had in 1991 was not an effort to try and get these committees which were established starting with Narasimhan Committee number 1 to assess whether the public banking system had achieved what it was set up to achieve or nationalized to achieve, the banking system was nationalized to achieve, but to shift the terrain of debate. The terrain of debate was now to be shifted in terms of saying that this is a banking system which seems to be inefficient, doesn't give appropriate customer service, doesn't innovate and give better products to its clients and customers, and of course, in large part that this was resulting from the fact that there was too much preemption of the banking sector's resources under nationalization, either by the government through the SLR or preemption because of the fact that there was a regime of directed credit at differential interest rates which sought and successfully achieved the provision of credit to the agricultural sector, to small enterprises, to smaller borrowers, etc. So therefore, the idea was shift the terrain of debate to one of efficiency and to actually not take into consideration the fact that what nationalization did was to say that, listen, we are not going to judge you on the basis of profitability because you're going to cross-subsidize activities which have very high transaction costs and therefore your profits would be low. That we are going to set up a whole new set of parameters to assess the degree to which the banking system has performed the duties it was supposed to perform. Now, rather than look at that, as I said, the terrain of debate was shifted. And that shift in the terrain of debate was not merely a shift to try and say that we should have liberalization, more competition, deregulation, etc. If we pursue the kind of ideology which has been stressed through these multiple committees, the game has been just one simple game, that of restoring control of the nation's savings to the big private sector. And finally, when in the last round or the third round of the licensing of private sector's banks, the government decided, or the Reserve Bank of India decided to include in its guidelines, subject to some notion of ring fencing which is impossible to achieve, that the corporate sector would be allowed to come in, even though the committee which was established to license the new set of banks got scared and therefore only gave licenses to IDFC and Bandhan Bank. But the rule had been put into the rule book and we know now surreptitiously through payments banks, through small finance banks, etc., the corporate sector is being allowed to enter, and this is the beginning of a process in which you're actually going to restore control over the nation's savings of the private sector in private hands. So therefore, when we see the government suddenly deciding, I mean, if you, for example, look at the recommendations which have recently been put out in speeches by senior functionaries of the Reserve Bank of India, what they said was, let us take these banks, let's sort of dismember them. There are parts of it which the private sector would be ready to buy. Let's sell that and really pay off, write off these loans, which in any case cannot be collected. Because partly we cannot hold the private sector for having done badly and not paid its debt. That's because the economic environment has been bad for them. So the idea was you break up the public sector banks, use some of their assets which can be sold as the means to finance the closure of debts which you wanted to put an end to without going out there and using all means possible to try and recover the advances that you had made and had gone bad. So this idea of actually, in some sense, moving it in one way or another was being pushed in large measure. Seen in that light, what the current recapitalization exercise really is the final recognition of the government that in order to be able to push through its agenda of privatizing the public banking sector, it will not be able to do it with all these clever ideas with the Viral Acharya might give you, that the only way you can do it is like the Indonesian government did after the Southeast Asian financial crisis. You first take the banks, use state money, use money from the treasury to actually set their books right, and then carry it to the market. Then there's a possibility that they would be bought. If you carry these banks to market now, nobody is going to actually come and buy these banks because they'll have to take on the liabilities that these banks are currently holding. So therefore, the whole idea is, unlike it being a first measure to move back and reverse a set of policies which have been pursued and has put the banking system in the current state it is, this is merely another way of using tomorrow's taxpayers' money to actually recapitalize and clean the books of the bank so that you can carry these banks to market, unless of course the government is stopped either by the people in the next elections or by all of those who are going to agitate against this effort to try and, as I said, hand over control over the nation's savings to the private sector. Now, there is one point we must note here, is that if you look at this shift in the terrain of debate which occurred in the 1990s as part of this program, which still is an incomplete, an unfinished agenda as far as the Indian state is concerned, that if you look at the shift in the terrain of debate, one thing which was constantly stated is that the success of neoliberal reform in the banking sector was illustrated by the dramatic decline in the ratio of non-performing assets to gross advances, which we know from something like 20% plus. And you know, when the ratio of non-performing assets to gross advances was 20% plus, nobody said that the public banking system in India is going to collapse. They basically said this is a problem which has to be resolved through recapitalization in one form or the other, and changes in banking practices in appropriate fashion, such that banks should do what they are supposed to do, but do it in a way in which they don't accumulate large non-performing assets. So the argument was that, listen, this was all accumulated, as I said, because of the fact that you had directed credit and differential interest rates, and because there was preemption of bank resources by the government through the SLR, and therefore they had to sort of hold low return securities issued by the government. That the idea was that if you can get rid of this, then you actually are illustrating the success of reform. And the fact that the ratio of non-performing assets to advances came down from 20% plus to something like 2 to 3% was presented in the early 2000s as being evidence of the success of reform. And it also said that if you went, for example, to the late 1980s, 50% of non-performing assets which existed in the books of banks was from the priority sector, only 50% was from the non-priority sector. So there is evidence that the priority sector is a big problem. We should get rid of this very idea, which Narasimhan Committee obviously right away said in 1991, because Narasimhan being Narasimhan, when banks were nationalized and he had to write a report, he wrote it in a way in which suited the nationalized banks. When banks were to be denationalized, he wrote a report which suited privatization of banks. But basically what we had was an argument, a statement which essentially said that not only have non-performing assets come down, but the share of these non-performing assets contributed by the priority sector has come down as well, so that we've actually resolved the problems which neoliberal reform was attempting to address when it was put in place in the early 1990s and after. So the argument was, listen, we are not going to look at whether nationalization achieved what it was supposed to achieve, but we are going to look at whether neoliberal reform achieved what it set out to achieve, and the argument was that neoliberal reform had achieved it. Now we know why that achievement could have been shown. We know that that could be shown because part of neoliberal reform was an attempt to try and create a situation in which debts which were actually non-performing, if you go by a set of strict guidelines, were now not being declared as non-performing because they were taken to the corporate debt restructuring cell. They were being converted into restructured standard assets, and therefore they were not being shown as stressed assets at all. The result was, when as a result of the credit boom of the 2008 2003 period onwards, year onwards, you began to see non-performing assets coming. And then Raghuram Rajan said that, listen, when I look at these non-performing assets, I think that actually there's much more there, because the kind of asset quality review which is needed in order to establish the nature of assets on the bank's books was not good enough, and therefore we need to change the nature of the asset quality review. We ended up in a period of 2 to 3 years in a sudden dramatic increase in the volume of non-performing assets, with, we know now, something like 3/4 or more of the non-performing assets coming from the non-priority sector, most of it coming from a few borrowers, and we of course knew, partly because of the fact that you had to take it to the NCLT, that the 12 top borrowers accounted for, the top defaulters accounted for something like 25% or more of the total non-performing assets. So if you actually look at it, neoliberal reform, by the sort of claim it had made in the early 2000s of its own success, is today shown to be a deep failure. It has not managed to achieve, but in fact, it has done exactly the opposite. And partly because of two things, and I shall end more or less with that. One, what it did was, it did away with the idea that you need to have a specialized development banking segment in order to be able to provide capital to large capital-intensive projects, and there must be access which those development banking institutions have to budgetary resources, to special funding from the Reserve Bank, and a borrowing ability which will keep interest costs low such that it can undertake development banking initiatives. You got rid of that in the name of ostensibly creating a level playing field for the private banks that you wanted to encourage, but it didn't come up in any significant number. But just look at other countries. Look at Brazil. BNDES is a huge behemoth of a development bank. Brazil is a country which has also, like India, pursued financial liberalization, but they didn't close down BNDES. BNDES has grown from strength to strength with support from the budget. Look at China. China was a monobanking system, didn't have a development bank. It is when China decided to go market-friendly after 1978 that the China Development Bank was set up, and therefore now we have this huge behemoth called the China Development Bank, which operates not merely in China but all over the world, in Africa, other parts of Asia, etc., part of the Belt and Road Initiative. The argument is clear. If you are in a market-based system, you need specialized institutions to finance capital-intensive projects or infrastructural projects. You cannot hand that over just to the normal banking system. By doing away with that specialized bank, you created an environment in which you would have to force the banks to do what they shouldn't be doing, and that's where most of these non-performing assets are coming. The second is that you not only forced them through persuasion because they were publicly owned, you did it by flooding them with deposits. And why did they get flooded with deposits after 2003? They got flooded with deposits after 2003 because external financial liberalization resulted in a situation where, as compared to something between $3 and $6 billion of foreign capital coming into the country every year, we reached a situation where anywhere between $60 and $80 billion of foreign capital was coming in every year. We didn't need these to finance our balance payments expenditures. They were far in excess of what was required to finance the current account deficit, and therefore this went into actually an environment in which there was a huge increase in deposits. Banks, if they take deposits and pay interest, cannot but lend. They had to find new areas to lend. One area they found, and successfully, because we don't have too much non-performing assets out there, was retail lending, the share of which went up from something like 8-9% of total advances to something like 25% of total advances, where advances themselves have grown hugely. But they were pushed into lending into areas which they thought had implicit sovereign backing or sovereign guarantee. These infrastructural areas, which the government said has now to be undertaken either by the private sector or through public-private partnerships, because the third feature of reform, besides doing away with development banking, besides allowing huge amounts of capital coming into the system and flooding the economy with liquidity, the third aspect was the government will not tax and will not run deficits, which means the government cannot undertake infrastructural investments, and therefore you ended up with a situation where you pushed banks, even by the overall neoliberal policy environment, into doing what they did. All of this actually points not merely to the failure of neoliberalism in the banking area, it points to the deep failure of neoliberalism across the board, independent of whether we look at the state of social deprivation and the level of poverty this country still has. But then you conceal all of that by manufacturing a bunch of numbers which makes India the fastest growing economy in the world when it is sitting with this sort of bombshell in its banking sector, which the government is now using to hand over control over the nation's savings to the private sector. The fact that this has to be stopped is too obvious. This has to be stopped in banking. We have to convert this opportunity where banks' books are being restored, not to turn them into entities which are going to be handed over to big business, but really we have to use that as an opportunity for medium-term and sort of longer-term policies which restores the role of banking within the Indian economy, social banking within the Indian economy. And to do that, of course, the battle for sort of saving public sector banking is also a battle against neoliberalism. And for those of us who've sort of been studying this and trying to understand it for a long period of time, it's always an inspiration that there are institutions like IBOACC which are at the forefront of this battle. And more power to your elbow. We hope you will win this battle, and whether you do or not, we'll be with you in the struggle.